Hi, it's Mark Ferguson with Invest for More, and welcome to another video on rental properties. Today I want to talk about paying off your mortgage versus buying more properties or saving your money. This is a very difficult topic to talk about because what you want to do will depend greatly on what your own goals are, what your comfort level is, and where you are in your life and in your investing career. I personally have changed strategies on this a couple times. When I first bought my rental properties, I was using the snowball method to pay all my rental properties, or take the cash flow from all my rental properties to pay one off. So how that works is I had about $500 in cash flow a month coming in on each rental property. If I had 5 rental properties, that's about $2,000 each month I could use to pay off one mortgage. Now the great thing about this strategy is it pays off a mortgage very quickly. I think it's a much better strategy than taking your extra cash flow to pay off each individual mortgage at the same time. The reason I say that is because if you have 30-year mortgages or 15-year mortgages, it doesn't really matter because you're using extra money to pay that mortgage down. But if you pay each mortgage off at the same rate, each house has an extra $500 going to paying off that mortgage, it will take, 7, 8 years, maybe 5, maybe 10, depending on how many properties you own, to pay off all of those mortgages at one time. But if you take that money and pool it together and pay off one mortgage at a time, you can pay off that mortgage much more quickly. So I paid my mortgage off just over 3 years after I bought my first rental property. That's a huge bonus because as soon as I pay off that mortgage, I have extra cash flow coming in because I don't have a mortgage payment anymore. And I still have to pay the taxes and insurance, which were included in my mortgage payment, but I no longer have to pay that $400 or $450 in interest in principal every month. That's a lot of extra money coming in. Then I can take that extra cash flow and move it into the next property, pay it off even quicker than the first one. That is why it's better to pay off one at a time than all of them at once, because you will realize that extra cash flow coming in much sooner than paying them all off at one time. Instead of having to wait 8 years to get this huge lump sum of extra cash flow coming in, you only have to wait, 3 years, maybe 2 years, and you can use that extra money to get better returns, start paying off mortgages if you want right away. Now the reason I paid down my mortgages so fast to start with were a lot of different reasons. One is it's very difficult to get mortgages for investors in today's lending market. It's hard to get more than 4, it's hard to get more than 10 mortgages, and my thoughts were I wanted to pay one off quickly so I didn't have too many mortgages in my name at one time, and I wouldn't be able to get any more loans. Another thought was it would just be awesome to pay off a mortgage and say, hey, I own this rental property free and clear, I don't have a mortgage, and that looks really good to banks as well. If you have a house that's completely paid off, that tells the bank you're in a very stable financial position, you're not over leveraged, you have a lot of assets tied up in your properties. It's a great position to be in. And what I also did was I took that equity and I got a line of credit which I'm able to pull out or put back into the home at any time. And it's really nice to have that flexibility for flips I do. If I want to buy more rental properties, I don't have to use the money. It's not like a refinance where once you take the money out, you could pay off the loan, but you can't take the money back out again. Once that loan's paid off on a refinance, that money's paid off. It can't come back out. Line of credit, you can keep taking that money in, taking it out, and it's a great situation to be in. After I paid off my first rental property, I changed strategy a little bit. I decided to stop doing the snowball method for the immediate future. And there's a few reasons why I did that. One is when you're paying off mortgages, that money is not earning an incredible amount because usually your mortgage interest rate is pretty low. On my properties it's 4%, 4.5%. So really that money I'm putting into paying off those properties is only making that 4.5%. and I'm not really realizing that gain until I pay off the entire property. Now, it does help to pay down the loan on a property because the lower your balance is, the more principal every month that is going towards paying off the loan and the less interest. So it's not completely unbeneficial to pay more money towards your mortgage. You know, you are getting some benefit because your principal amount of your payment goes up over time. But you still won't see the huge benefit of investing that money into the mortgage until the mortgage is entirely paid off. So what I decided to do is to save up that money. I am now, you know, collecting my cash flow. I'm not using it to pay off a property every month. I am using it to help with my fix and flips. I have 8 fix and flips going. Earlier in the year, I had 10 fix and flips going. That takes a lot of capital. You know, I do have financing from my portfolio lender for the flips, but that's only 75% of the purchase price. And I do have some private money, but that is not enough to cover 8 flips, the down payments, the expenses, the repairs at one time. So that extra money from my rental property has been great for keeping my flipping business going. It's also a great way to build up capital to buy more rental properties, to pay for down payments, to pay for repairs if they're needed, because many times the hardest part about getting into rental properties is the money it takes to buy them. So, am I still worried about having too many mortgages in my name? I am at a certain extent, but my portfolio lender at this point does not have any limit on the amount of mortgages I can have. I have 11 mortgages right now. That doesn't even count the fix and flips, where technically I have another loan against each of my 8 flips as well. So for right now, I think I should be fine. I think I'm in a good financial position by saving that cash flow, by not paying off properties, but that could always change in the future. And one last reason I just remembered to talk about why I've paid off my properties was because I get an ARM for my loans when I buy my rental properties. So an ARM is an adjustable rate mortgage, and what that means is the first 5 years when I get a loan is a fixed rate. 4.5% was my last rate. At the 5-year mark, that rate can adjust up or down with rates so low I can't see them adjusting down anymore, but it could go up, 2% that first year. I think it caps off at 8.5% total over the life of the loan. It can't get any higher. But that's still, almost twice the interest rate I'm paying now. It only goes up if interest rates were to go up significantly, which they may or may not do. But it's another consideration where if I have, 12 rental properties or, however many rental properties I have, and all the loans start adjusting at the same time period, that's going to significantly decrease my cash flow. And it would be nice to have some of those loans paid off before the ARMs can adjust and decrease my cash flow. So that was my thinking as well on paying off the loans early. Now I can still do that. I just am saving that money, using it for the flips, maybe using it to buy more rental properties until I get to a point where my ARMs might start adjusting. So the first loan I have now that could adjust would be in 2017. So I still have quite a bit of time. I've got the end of 2017, so I have almost 3 years before that first loan could adjust. I have some time. And at that point, who knows? Maybe interest rates won't be up any higher. Maybe it won't adjust at all and I won't have to worry about it. Or I could think about paying it off or even refinancing it at that point. We'll see what happens. But the point is, how you pay off your loans, how you buy new rental properties is all going to be very personal to you. Many people hate debt. They can't stand it. It makes them feel uncomfortable. They get anxiety from it. If that's you, maybe you don't want 11 mortgages in your name like me. Maybe as soon as you get a rental property or two, you want to start trying to pay it off as quickly as possible. Other people might want to buy as many rental properties as they possibly can. They've got great cash flow. The problem is they just don't have enough cash to buy those. They may want to save up their cash flow, build up as much capital as they can so they can keep buying rental properties in the future. Very personal choices. It's hard to say which one is better. I think I like the way I did it because it's very advantageous having a house paid off, and in the future we'll see if I want to pay off any more. But for right now, I think I'm happy accumulating that cash flow, using it for the fix and flips, and then also when I find more deals, it's been tough lately, buying more rental properties with that cash flow. So thanks again for watching. Again, please check out investformore.com. Have over 300 articles on rental properties, fix and flips, and becoming a real estate agent, and a lot more videos as well. Have a great day.